Most traders focus on indicators, but professional traders focus on one specific candle formation that reveals when the market is about to reverse. This formation appears when the market completely traps traders on one side and then suddenly moves in the opposite direction. When you understand how this pattern works, you'll start seeing powerful reversal opportunities that most traders completely miss. In this video, you'll discover the powerful candlestick pattern most traders overlook, the hidden structure inside this setup, what really happens between buyers and sellers, how to use this pattern to trade with the trend, how to spot powerful reversals against the trend, how this setup works inside sideways markets. You will also learn 4 advanced trading strategies. Make sure you stay until the end, because the last 4 strategies are where this candlestick pattern becomes extremely powerful. Before we dive in, if you want to learn more smart money trading strategies and powerful price action techniques, make sure to like the video, subscribe to the channel, and turn on notifications so you don't miss the next strategy. Now let's get started. What is the Tsutsumi candlestick pattern? Let me ask you a question. Do you know Munehisa Homma? He is considered one of the greatest traders in history and the pioneer of Japanese candlestick analysis that traders still use today. One of the most important patterns he identified is called the Tsutsumi candlestick pattern. This pattern played a major role in his trading success and helped him build a fortune. The Tsutsumi pattern is a 2-candlestick formation. It appears when the second candle completely engulfs the previous one, signaling that the balance of power in the market has suddenly changed. If the first candle is bearish and the second candle closes bullish and fully covers it, this suggests that buyers have suddenly taken control of the market, creating bullish momentum. On the other hand, if the first candle is bullish and the second candle closes bearish while engulfing the first, it signals that sellers have stepped in and taken control, creating bearish momentum. But what makes this pattern truly fascinating is how Munehisa Homma described it centuries ago. He summarized it with a powerful observation: when one day consumes another, the market's intention has changed. Think about what this means. One side of the market was winning. Then suddenly the other side appears with enough strength to completely erase the previous move. In just one candle, the balance between buyers and sellers shifts dramatically. This is why the Tsutsumi pattern often appears at important turning points in the market, where momentum changes and new trends begin. However, we won't use this pattern exactly the same way Munehisa Homma used it centuries ago. Markets have evolved, so candlestick patterns should be used together with current market conditions and structure. The first and simplest way to use this pattern is by trading it with the trend. Now look at this chart. The market is clearly making higher highs and higher lows, which indicates a strong uptrend. Here we can see a resistance level that was broken and later turned into support. When price pulls back and reaches that level again, a bullish Tsutsumi, or bullish engulfing candle, forms. This signal suggests that the retracement move is ending and that a new impulsive move to the upside may begin. But before taking the trade, we always check the higher time frame. Since we are trading on the 5-minute chart, we also need to analyze the market on a higher time frame. If we look at the hourly chart, we can see that the market was trending downward. Price broke below this support level and then closed back above it, creating a clear sell-side liquidity sweep. This tells us that many sellers were trapped by buyers and that the market is likely to move upward. As you can see, price then started moving up strongly, which supports our trade plan on the 5-minute chart. Now let's return to the trading time frame. We place our buy entry at the close of the second candle, set our stop loss below the pattern, and target the next key resistance level. And as expected, the market moves upward and eventually reaches the target. Now let's look at another example, this time in a downtrend. The market is clearly trending downward. Here, price breaks below this support level, which then becomes new resistance and later retraces back to it. Once the market approaches that level, a bearish engulfing candle appears. This suggests that the retracement move may be coming to an end and that sellers are likely to push the market lower again. Just like before, we check the higher time frame to confirm the market direction. On the higher time frame, we can see that the market is also trending downward. Price attempted to move upward, briefly broke above this resistance level, but then fell back below it. This tells us that the attempt to push the market higher failed and that sellers are still in control. Because of this, the market is likely to continue moving downward, at least toward this level. This also means we still have enough space to trade the move on the 5-minute chart. So we return to the trading time frame, place our sell entry at the close of the engulfing candle, set the stop loss above the pattern, and aim for the next support level as our target. And shortly after, the market moves down and reaches the target. Now let's move to the next strategy, trading this pattern in a range bound. Look at this chart. The market is moving between a clear support level and a resistance level, which means the market is ranging. In this situation, buyers and sellers are in equilibrium, and price tends to bounce between these two levels. Professional traders usually wait for price to reach either the support or the resistance level before looking for trading opportunities. Now look at what happens next. Price reaches the resistance level, briefly breaks above it, creating a false breakout. Right after that, a bearish engulfing candle appears. As you can see, the body of the second candle completely engulfs the body of the first one. The wick does not have to be engulfed, that is not an issue, and the engulfing pattern is still valid. This signal suggests that many buyers were trapped in the false breakout, and the bearish engulfing candle indicates that the market is likely to reverse and move back toward the support level. But before taking the trade, we check the higher time frame. The market on the hourly time frame is clearly ranging. Here, price gets rejected from the resistance level, and we can see a bearish engulfing candle forming. This suggests that the market is likely to move downward toward the support level. This analysis supports our trade setup on the 5-minute time frame. Now let's go back to the trading time frame. We place our sell entry at the close of the engulfing candle, set the stop loss above the pattern, and aim for the next support level as our target. And as expected, the market moves down and reaches the target. Now, what if the market breaks out of the range? Look at this chart. Price breaks below the support level, which signals a potential breakout. But once the breakout happens, you don't enter immediately. Professional traders know that many breakouts are followed by a retracement. So instead of chasing the market, you wait patiently for price to pull back toward the broken support level, which now becomes new resistance. Then you wait for the formation of this setup. As you can see, the market retraces back to that level, and a bearish engulfing candle forms. This signal confirms two important things. First, the breakout is valid. Second, the retracement is likely over, and the market may begin a new move to the downside. At this point, you place your sell entry at the close of the engulfing candle, set your stop loss above the pattern, and aim for the next support level as your target. Once the trade is placed, you let the market do the work. Set the trade, and forget it. Now let's see how to use this pattern to trade against the trend. Look at this chart. At first, the market is clearly in an uptrend, making higher highs and higher lows. Then price reaches this level and reverses. Later, the market returns to the same level again and reverses once more. This tells us something very important. Buyers have tried twice to break this level but failed. That means the bullish momentum is starting to weaken. Now look at what happens next. The market approaches that level for the third time, and once price reaches it, a bearish engulfing candle appears. This signal suggests that buyers are no longer strong enough to push the market higher, and that sellers may be taking control. The bearish engulfing candle confirms the potential beginning of a new move to the downside. This becomes a potential trading opportunity. You place your sell entry at the close of the engulfing candle, set your stop loss above the pattern, and aim for the next support level as your target. And remember, before taking this type of trade, always perform a top-down analysis to make sure your setup is aligned with the higher time frame context. Now let's move to a more advanced trading strategy using this pattern. Look at this chart. As you can see, the market hits this level and reverses, forming a clear resistance level. This area becomes what traders call a liquidity zone. Why is this important? Because around these levels, a large number of orders are placed. Some traders place buy stop orders above the resistance, others place sell limit orders, and many traders place their stop loss orders around this level. All these orders create a pool of liquidity, which is closely watched by institutional traders. Now pay attention to what happens next. When the market approaches this level again, price breaks above the resistance, creating what looks like a breakout. But immediately after that, a bearish engulfing candle forms and closes back below the level. This is a very important signal. It suggests that institutions have swept the liquidity above the resistance, triggering stop-loss orders and breakout traders. Once that liquidity is taken, the market often moves in the opposite direction. So the bearish engulfing candle confirms that the liquidity sweep has occurred and that the market is likely to move downward. Before entering the trade, you perform your top-down analysis to make sure the higher time frame supports your idea. If everything aligns, you place your sell entry at the close of the engulfing candle, set your stop loss above the pattern, and aim for the next support level as your target. And as you can see, the market moves down and reaches the target as expected. Now let's look at another example, this time at a support level. Look closely at this chart. As you can see, the market reaches this level and reverses, forming a clear support level. When this level appears, it attracts a lot of attention from traders. Why? Because many traders see this level as strong support. Some traders place buy limit orders at this level, expecting the market to bounce. Others place their stop-loss orders just below the equal lows. All these orders create a large pool of liquidity below the level. Now here is where things get interesting. When the market approaches the level again, instead of bouncing immediately, price briefly breaks below the level. At that moment, many traders believe the market is breaking down. Stop-loss orders get triggered. Breakout traders start selling. But then, something unexpected happens. A strong bullish engulfing candle appears and closes back above the level. What just happened is called a liquidity sweep. The market briefly moved below the support level to collect the liquidity resting under the support level, and once that liquidity was taken, buyers stepped in and pushed the market higher. The bullish engulfing candle confirms that buyers have regained control, signaling a potential move to the upside. After confirming the setup, you perform your top-down analysis to make sure the higher time frame supports the trade idea. If everything aligns, you place your buy entry at the close of the engulfing candle, set your stop loss below the pattern, and aim for the next resistance level as your target. And as expected, the market moves upward and reaches the target. Now let's see how this pattern becomes even more powerful when combined with supply and demand zones. Look at this chart. As you can see, the market previously made a strong impulsive move downward from this area. This tells us that a large number of sell orders were placed here, which forms what traders call a supply zone. These zones are important because when price returns to them, institutions often look to enter the market again. Now watch what happens when price retraces back to this supply area. The market slowly moves upward and eventually reaches the supply zone. At that moment, many traders believe the market will continue rising. But then something interesting happens. A bearish Tsutsumi or bearish engulfing candle appears inside the supply zone. This is the key moment. The engulfing candle shows that sellers have stepped in aggressively, rejecting higher prices. In other words, the supply zone is still respected and the engulfing candle confirms that the market may move downward again. This combination creates a high probability trading opportunity. First, you perform your top-down analysis to make sure the higher time frame supports the bearish idea. Then you place your sell entry at the close of the engulfing candle, set your stop loss above the supply zone, and aim for the next demand level as your target. Now let's look at another example, this time at a demand zone. Look at this chart. Earlier, the market made a strong impulsive move upward from this area. This tells us that large buyers stepped into the market here, creating a demand zone. These zones often act like price magnets. When the market retraces back to them, institutions may look to accumulate positions again. Now watch what happens next. After the impulsive move, the market begins to pull back slowly toward that demand area. Many traders start thinking the market will continue falling, but once price reaches the demand zone, something interesting happens. A bullish Tsutsumi or bullish engulfing candle suddenly appears. This is the key moment. The engulfing candle shows that buyers have aggressively stepped in, rejecting lower prices. In other words, the demand zone is still being defended by strong buyers. This is the moment where the market reveals its intention. The bullish engulfing candle confirms that the retracement is likely over, and that the market may begin a new move to the upside. After confirming the setup, you perform your top-down analysis to make sure the higher time frame supports the trade idea. If everything aligns, you place your buy entry at the close of the engulfing candle, set your stop loss below the demand zone, and aim for the next resistance level as your target. And as you can see, the market moves upward and reaches the target. But there is a big mistake that many traders make when using this strategy. They don't know how to correctly identify a supply or demand zone. Look at this chart. Before placing any trade, we must first identify a valid supply or demand zone using clear criteria. First, candle strength. A valid zone is usually created by strong, large candles moving in the same direction, which indicates institutional momentum. If the candles are small, choppy, or full of wicks, the move is weak and should be ignored. Second, the freshness of the zone. The best zones are fresh zones that price hasn't revisited yet. The first test of a level is usually the most powerful because that's where unfilled institutional orders may still exist. Third, break of structure. A high-quality zone often forms after price breaks an important level, such as a previous high or low. This breakout signals a shift in market structure and suggests that institutions may be driving the move. Finally, the risk-to-reward ratio. Only take trades that offer at least 3 times the potential reward compared to the risk. Without proper risk-to-reward, even good setups can become unprofitable over time. Without these criteria, traders often draw random levels on the chart, thinking they have found a supply or demand zone, and when they combine a candlestick pattern with random levels, the setup loses its reliability. This is one of the main reasons why many traders fail when trying to trade these patterns with institutional levels. So always remember, the quality of the level is just as important as the candlestick signal itself. Now let's move to the next strategy, combining the Tsutsumi pattern with the 21 and 50 simple moving averages. Look at this chart. As you can see, the market is clearly trending upward. The first condition we look for is the moving average crossover. The 21-period simple moving average must cross above the 50-period simple moving average. This crossover indicates that bullish momentum is building in the market. After the crossover, we wait for the market to pull back toward the 21 moving average. This pullback often acts as a dynamic support level during an uptrend. Now pay attention to what happens next. When price reaches the 21 moving average, a bullish Tsutsumi or bullish engulfing candle appears. This signal suggests that the retracement is ending and that buyers may be ready to push the market higher again. At this point, we place our buy entry at the close of the engulfing candle, set our stop loss below the pattern, and let the market continue its move. The exit rule for this strategy is simple. We stay in the trade as long as price remains above the 21 moving average, and we close the position once price breaks below the 21 moving average. This makes it a trend-following strategy designed to capture the continuation of strong market moves. Now let's look at the opposite scenario. On this chart, the market is starting to show bearish momentum. The first signal appears when the 21-period moving average crosses below the 50-period moving average. This crossover suggests that sellers are gaining control of the market. After the crossover, we wait patiently for the market to pull back toward the 21 moving average, which now acts as dynamic resistance. When price reaches that level, a bearish Tsutsumi or bearish engulfing candle forms. This is the confirmation we are looking for. The engulfing candle indicates that sellers have stepped back into the market and that the downtrend may continue. At this point, we place our sell entry at the close of the engulfing candle, set our stop loss above the pattern, and stay in the trade as long as price remains below the 21 moving average. Once price breaks above the 21 moving average, the trade is closed. Now let's move to the final strategy, which combines the Tsutsumi pattern with Fibonacci golden zones. Look at this chart. As you can see, the market first makes a strong impulsive move upward. This tells us that buyers are clearly in control of the market. But markets never move in a straight line. After the impulsive move, the market begins to retrace downward. This is where we start preparing for a potential trend continuation trade. To identify a high probability entry area, we take the Fibonacci retracement tool and measure the move from the swing low to the swing high. The area between the 50% and the 61.8% retracement levels is known as the golden zone. Why is this zone important? Because this is where professional traders often look for pullback entries. Now watch what happens next. Price retraces directly into the golden zone, and right at that moment, a bullish Tsutsumi or bullish engulfing candle appears. The retracement reaches a key Fibonacci level, and the engulfing candle shows that buyers have stepped back into the market aggressively. In other words, the pullback is likely coming to an end, and the trend may continue upward. At this point, we place our buy entry at the close of the engulfing candle, set our stop loss below the pattern, and aim for the next resistance level as our target. And as you can see, the market moves upward and eventually reaches the target. Now let's look at the opposite scenario. On this chart, the market first makes a strong impulsive move downward, showing that sellers are controlling the market after an uptrend. After that move, the market begins to pull back upward. Just like before, we take the Fibonacci retracement tool and measure the move from the swing high to the swing low. Again, we focus on the golden zone between the 50% and the 61.8% retracement levels. Now pay attention to what happens when price reaches this area. The market enters the golden zone, and suddenly a bearish Tsutsumi or bearish engulfing candle forms. This is another key moment. The retracement reaches a high probability resistance zone, and the engulfing candle confirms that sellers are stepping back into the market. This suggests that the pullback may be coming to an end and that the downtrend is ready to continue. So we place our sell entry at the close of the engulfing candle, set our stop loss above the pattern, and target the next support level. And as expected, the market continues downward and reaches the target. Now, before you start using this strategy, there are 3 critical mistakes that many traders make. Avoiding these mistakes can make a huge difference in your trading results. Look at this chart. On the trading time frame, we can see a clear bullish engulfing bar forming at support. At first glance, this looks like a perfect buying opportunity. Many traders would immediately take this trade, but here is where the mistake happens. Before entering any trade, we must always perform a top-down analysis. So when we switch to the higher time frame, we notice something important. On the higher time frame, which is the hourly, the market started trending downward after an uptrend. Price broke below this demand zone and is likely to continue moving down toward the next demand zone below. This indicates that our trade on the 5-minute chart should be avoided, because on the higher time frame, the hourly chart, the market is moving downward. If we go back to the trading time frame and take the trade anyway, the market may move slightly upward at first, but eventually the stronger higher time frame trend takes control, and the trade fails. The lesson here is simple. Never trade against the higher time frame momentum. The larger trend always has more power. Now let's look at the second mistake. Look at this chart. The market first makes a strong impulsive move upward, followed by a small retracement. We measure this retracement using the Fibonacci tool, which gives us the golden zone. Now look at what happens next. Once the market reaches the golden zone, a bullish engulfing candle forms. This usually indicates the end of the retracement and the beginning of a new impulsive move upward. At first glance, everything looks perfect. The higher time frame also supports the trade. But now we need to calculate the risk-to-reward ratio. As you can see, after placing our entry, stop loss, and target at the resistance level, we notice that the reward-to-risk ratio is less than 2-to-1. Now watch what happens. The market actually moves in our favor, and we start to feel excited. But over the long run, trades with poor risk-to-reward ratios destroy profitability. Even if some of them win, they don't compensate for the losses. That's why professional traders follow a simple rule. If the trade does not offer at least a 2-to-1 reward-to-risk ratio, skip it and wait for a better opportunity. The third mistake is trading this setup everywhere on the chart. Look at this example. Here the market is moving sideways inside a range. We see an engulfing candle forming right in the middle of the range, and some traders might try to take this trade. But look at what happens next. The market doesn't follow through, and the setup fails. Why? Because during a range-bound market, price tends to move between support and resistance boundaries. Look at this chart example. The best trading opportunities usually appear at the edges of the range, not in the middle. So, when the market is ranging, you should only look for trades near support or near resistance, where the probability of a reversal is much higher. Now you understand how the Tsutsumi candlestick pattern works and how to use it in different market conditions. Remember, the pattern itself is not the edge. The real edge comes from market context, proper analysis, and disciplined risk management. If you found this video helpful, like the video, subscribe to the channel, and turn on notifications so you don't miss the next strategy. Thank you for watching and see you in the next video.